Hello and welcome back to the Property and Lending Podcast. Joined with us as always is Mark and Fadi from Power Loans, and today we've got another very special guest with us. We've got Alan from ZENRG Finance, and Alan is a mortgage broker. He's been a mortgage broker for about 10 years, running his own business. He's got 10 brokers in his team, so quite a large team. He's previously in the banking industry as well, so he knows the ins and outs of the banking industry, and that ZENRG Finance, they're consultants. They help you purchase properties, and they're your property purchase partner. They provide peace of mind and ongoing education and support, and they'll walk you through the finance forest, helping you compare loans, make a purchase, refinance your property, and potentially save thousands of dollars in the process. So the kind of guests we like to speak to. Before we get into this conversation, as always, all advice is, well, it's not advice, it's just general chat. So before you make any decisions or whatnot, obviously have a chat to Alan himself, or relevant financial people in the industry, and just don't take any advice from here as gospel, I guess. Alan, welcome to the show. How are you?
Thank you. Yeah, good. You guys?
Good. Great.
Trying to keep up with all these rising interest rates, and now doing more pricing approvals as ever. So yeah, trying to keep up with that.
Yes, which is good. And we're brokers, and good to see that now, more than 50% of clients are not just going to the banks and using us as mortgage brokers and getting good quality advice, which is the key thing, isn't it? Yeah.
Absolutely.
I was going to start, KM. Sorry, I was going to just quick question for Alan. This is just a question I ask most of the brokers that we talk to. What's your conversation these days in regards to what rate the customer should be going on, whether it's fixed or variable? And what conversation are you having with customers in regards to what rate they're going for? Because we're now moving from customers always wanting to fix their rate for 4 or 5 years, because we just saw incredible rates in the last couple of years. And now we're shifting where we're trying to keep up. We've got a few rate locks in place, etc. So what's that? Not so much advice from you, but what's that conversation that you're having with customers these days?
Well, I think it's firstly, customers, some do like fixed, and some prefer variable, right? Depends, every situation different, of course, right? But I feel the fixed rates, of course, it's higher than the variable rates, right? I guess talking to clients, it's more around what they're comfortable with, right? If a client is first home buyer and they're concerned that the rates are going to be continuously going up, I think part of our conversation to provide that certainty is, of course, offering fixed rates and talk about rate lock. Then they know, and having that peace of mind and comfort that it's not going to move for the X amount of years that they locked it in, right? So we explained it. Whereas I feel like in my career, and I'm not sure, I started in 2005 and 6, like back in the big banks, the rates were like 7-8%. I have some staff working with us, and they were saying in the 90s were like 18%, right? So we have dramatically seen interest rates going down, and this is the pivotal point where it's just gone the other way, right? We've experienced like lower rates, and and if you were fixing at the bottom, which is probably 1 or 2 years ago during the pandemic, congratulations, you probably locked in at the lowest rates. But now it's probably seeing 2 or 3 years fixed like higher than the variable rates. So I guess if someone wants to save money in the short period of time, I mean, we don't have a crystal ball. We don't know if the RBA is going to continue to rise even more. Then, of course, for a lower rate, then variable is a better option, isn't it? Right? Everyone's different, but I think we talk about those options, and then, of course, the client, and provide that best interest duty and disclose everything. And that's the key thing for us, right? To provide options, isn't it? Yeah. I know it doesn't answer the question, because it's not whether it's fixed better, variable better. It depends what they want, isn't it? That's the key thing. Yeah.
No, because we get a lot of phone calls coming in now, and it's like more of an awkward conversation. Like, oh, but my mate's on 2.54. I'm like, yeah, your mate probably got a fixed rate during COVID, and bought during COVID. And then like we're saying fixed rates now going above 5%. So it's
right.
And the variable rates are in the 3%. So it's just that bit of a conversation that we have before submission, where during COVID it wasn't so much of a conversation. It's like, yeah, fixed now, 4 or 5 years.
Yeah. So now it's variable's cheaper, no doubt. But I guess the question also, even if your mate were locked at a lower rate, right? Sooner or later, and when they finish their fix, we're going to enjoy that higher variable rate of 3 or whatever that interest rate's going to be in the future. I guess the key thing for us as mortgage brokers is more helping the clients plan. Do they have enough buffer, right? I mean, I think it leads to our next conversation, which is, other people's money, or is there equity in your home? And I think forever more important, I'm a big guy on OPM. And for those who don't know OPM, it stands for other people's money, right? Yeah. So I love extracting equity because, and structuring, right? So let's talk about equity. Equity is someone that, their first home, they've been, Fadi, you've been paying principal and interest, you've owned your home loan or your home for 5 years, you built up, hopefully a bit of equity, and your house gone up a bit in value. We can count, brokers can calculate that very easily, but that equity can be extracted out given you can borrow, or the borrowing capacity, and gives you that buffer in case rates do go up, uncertainty expenses come up, and that's where we can utilize that or further investment, right? So that's number one, that's critical. Another conversation where we've had 3 rate rises, right, as we know. What people don't know, and it may be like an assumption, oh, my mom and dad, used to have a home loan and paid it for 30 years, always been one single lender. The younger generation don't know that you can actually refinance. And some of the questions from clients will be, when can I refinance? Well, a simple answer is like, if you've got 6 months worth of repayment history, you can pretty much refinance, right? But why am I saying that, or using a mortgage broker, is because let's say you built up a bit of equity, you can restructure the loan, refinance at the lower balance, and then the equity can be extracted. I mean, I'm using a bit of terminology here, like interest only with an offset, right? Which means you're not actually paying interest, but you get the benefits of accessing that cash and paying interest only if you utilize that loan. How good is that, Fadi? Structuring is our kind of key word nowadays, isn't it? Yeah.
And I feel we saw a lot of that during the COVID period, where people were refinancing because their property was valued 250 to 300K more than it previously was. And we saw a lot of people actually accessing that equity. And I think KM would know that they were purchasing investment properties around the country as well. So that's something that we unlocked, and what you just touched on as well in regards to structuring the existing loan and structuring the new purchase as well, in regards to cashing out as an investment portion on your own occupied, and then purchasing the 80% that KM, I think, purchased over 55 or 65 properties in the last year. And I think that's what we saw a lot of success in. Yeah.
And that's amazing. And I think always when clients go to me, yes, finding a cheaper rate is definitely what a mortgage broker does, but only probably as one of the many talents that we do. Because we do equity extraction, or pandemic, like during the times, provide a cash out or equity loan. And if they bought another property 2 years ago, and now this is not investment advice, like they again would have gone up in value and made some money, right? So it wasn't about the rate. The conversation is, what are you going to do with that money, and what's your need and your objectives? So I think by understanding that, it hopefully removes a bit of fear and the listeners in the room, because they always focus, oh my God, it's a rate hike and all that stuff. But, another factor that we've been talking about as brokers, like the banks already factored in during the pandemic or the lowest times, a 2.5% buffer additional on your repayments anyway. So, technically you should be able to afford. Yes, it's a bit squeezed, and no more Uber Eats and kind of like, occasional spending. But at the same time, you can afford it, right? But you might have to review your budget, and hopefully the discretionary expenses you just have to review, right? But yeah, people get scared because it's continuing to rise, but things go up, go down, they fluctuate, right? That's what we are experiencing at the moment. Yeah. Sorry, I've just gone a bit elaborated, but hopefully it's
perfect.
I was going to say also, like I personally refinanced just not too long ago, within the last few months, and I locked in 2 years ago at a much, maybe 1.3% lower the fixed rate than what I got now. But yes, because I restructured, the repayments are actually lower, even though the interest rate, is 1.3% higher. So I think a lot of customers, like you said, they're just chasing the lowest rate on the market. But by going to a mortgage broker, we can provide that advice that by structuring it this way and using your savings in your offset account and using your redraw and all that sort of stuff, your repayments may actually be less than if you picked a fixed rate that was much lower than what you're actually getting. So it's very important to go through your personal circumstances with your broker who can structure it properly so that you're optimizing your situation.
Yeah, and in fact, it should be every year. Obviously, if you haven't saw a broker in the last 2 years, you're missing out on maybe some lower interest rates. Secondly, equity that, if you revalued, I mean, I'm talking about Sydney as a general. In the last 2 years you bought, you probably have some equity that you can extract and, further your investment, whether it's with First Brick or any like other investments, right? So I think it's critical to even Philip Lowe, RBA chairman, said like you need to have a buffer. I mean, his words said that, and it's just promoting that we should be like mortgage brokers ringing our clients. Yes, we've got your low rate. Have you got your OPM in place, right? Other people's money. And I'm a big fan because Australia, to be honest, like if I was to look at US different home loan structures, because in US you have to get a loan and amortize. There may be not the bells and whistles like an offset and like interest only with an offset. I know you guys been in the industry, but 10 years ago we were doing owner occupied interest only with offset. So cash flow wise, it just helps dramatically. Now I won't go into it in this segment, and plus owner occupied mostly is structured as principal and interest. So structuring is always the key, man. I can show you a lower repayment if I could do owner occupied interest only with an offset versus a P&I any day, right? So I know it's technical in some of these terminology, but it's just we've been brought out to go, hey, you got to pay your home loan over 30 years, which is not the fact, right? It's a myth buster, isn't it? Yeah. Sorry.
Yeah, for sure. I think no, you're right, mate. I think something you mentioned right at the start, and I never actually thought about it like that, was a lot of the younger generation, their parents and whatnot who purchased property, the mindset was definitely pay down debt, and then that's it. I know like my parents quite similar, and a lot of parents are probably very, very similar. And you didn't really discuss finances around the dinner table and whatnot. And it was just much, you buy a house, pay down the debt, and then when you're done, you're done. Thank God for that. Why would you put yourself into other debt? But I think and I've never thought about it like that. The younger generation might not even know. I guess because we're in the industry, you kind of sometimes forget that people don't know what a refinance is. People don't know what equity is and how you can use that to further enhance your portfolio. And I think if you don't want to work till you're 65, and if you want to have some buffers once you're done and some reserves, you have to definitely be investing and speaking to the relevant people to restructure and see the best way forward. As well, I think that something that as well Mark mentioned, being like it's very personal to your circumstances. I had a conversation with a client yesterday about let's say I've got 600 grand. Should I buy one? Should I split it by two at 300? And the answer is not as simple as one or the other. We really have to deep dive into their circumstances and what they're trying to achieve. And when we kept kind of working out what they're trying to do, we found out they're actually going to go self-employed in the next 12 months, and that's going to affect dramatically their future borrowing potential. And they wanted some cash coming out of that property as I guess a safety net, because when you're self-employed, as you might not have an income for a little bit of time. It's very up and down roller coaster. So very important. I think it's very specific to your circumstance, and it's not as simple as just the lowest rate is always the best, for sure.
No. And I feel also, I just want to touch on the topic, like you talked about the debt, it's not taxation advice here, but there is a difference between good debt and bad debt, right? So, your owner occupied debt, unfortunately, is what they call the bad debt. Why? Is because you can't deduct any interest against your, personal derived income. Versus, if it's an investment and structured interest only, of course, speak to your accountant. But if there's a rental and income derived from it, of course, allowable deductions through the ATO, which means you can reduce your taxable income. Depends on what structure that's bought in. Now, I'm a person that walked the road of extracting equity myself and built my double-digit property portfolio, and that's basically through the same concept. And it's really important to understand that if obviously different clients, some are like first-home buyers, some are investors, but I guess if you're ever wondered, hey, what's the first step? Go see Power Loans or any broker, right? Myself, yeah, just to get the right advice on your situation, so we can guide you through this jargon and all this complexity that we're talking about. We're trying to make it simpler so you can take, some massive action, isn't it? Yeah.
I
Yeah,
think
I know.
Alan, you go.
No, go ahead. I was just going to
No,
make
no,
fun
no.
of you, Fadi. I was just going to say, I know me and you always have a conversation. Every time I call Fadi, I say, Fadi, give me more debt. I want more money. I want more loan. And he's always getting
My
angry at
anxiety
me.
goes up.
No, but go ahead.
No, I was just asking as well in regards to structuring as well. We're seeing like Mark and I, we're seeing a lot of customers come through and going through the SMSF route in regards to how to structure. And a lot of people are not aware. I'll go back to what Kane was saying before. You made a good point in regards to the younger generation not really knowing as much, because we are in the industry, we kind of have a grasp idea. But in regards to SMSFs, like how are you looking to structure it? New customers that are coming through, obviously there are a little bit more lenders that are coming to the table to offer a few SMSF deals now, compared to back in the days where we had the big four.
Yes.
So is that something that you're also structuring? And then one of the main questions is, and obviously we already know the answer is, can I cash out of my SMSF loan or my SMSF security? So, and how do you go moving forward in regards to structuring your next SMSF? And I think that's a question that's always been coming up.
Well, I think the first thing in relation to SMSF, I mean, they would have got advice with a financial planner and accountant to set all that up. That's number one thing, right?
Yeah.
We're just providing the finance. Now, before, yes, Fadi, like you said, it was banks doing it, everyone's doing it, but now it's probably like a handful of lenders that I know, right, are doing SMSF lending. I guess in terms of structuring, the key idea with self-managed super fund is you want to have that asset produce income so you can retire off, right? So it depends on the age, right? And also the advisor's recommendation, right? There is options to do interest only as an investment. It will be rented out, of course. But preferably, if you can, is knock down that debt, right? Because, it's your retirement, like you want to pay it off, whether it's through the rental from your employer contributions, which of course now has gone to 10.5%, right? If you're PYG. It should knock down the debt, not within 30 years, probably hopefully less because you're paying, ahead. And that asset's producing income that's, more better tax environment, hopefully, right? And enjoy the benefits, right? So, but you mentioned about cash out, I always tell my clients, it's not like outside, you can do OPM, a bit different, very regulated. So unless you're selling the property and paying the tax, then pretty much you just need to build another nest egg through the savings, and then you buy another property through the SMSF structure. That's kind of like how we've assisted clients to buy multiple properties. I mean, I've got a few properties in SMSF myself, but it's important to work with brokers that have a good understanding and have done it, because it's quite different to when you're purchasing a property under your own names or in a family trust. It's important to have the right advice, isn't it?
Yeah. And I think that we'll go back to, like you were saying, that's more of a positive sort of debt, I reckon, the SMSF, because once you're retired and once you're done working, you want to hang up the boots, you've got some sort of income that's coming through at a tax-free as well. So you're not actually paying tax on that income coming through no more. Even though it's a long-term, but super is always going to be long-term anyway. So
yeah. So, and then also it's not how much, deductions you're going to get at that time. It's how much you keep, right? And enjoy the cash flow, right? So, and just touching back also a bit about, perception. Like if I was telling, come from an Asian background, of course, if I told my mom and dad how much debt that I have, they probably fall off their chair, right? But and same thing when I married my wife and she said, hey, how come you have $1 million in debt? And I said, hey, baby, I've got more than $1 million in assets and income coming through, I know we laugh about it. It's the 2022 now. It's not back in the 80s, 90s where the perception is you got to have that debt and pay it off. Now, that's why it's important to work with experts like mortgage brokers, buyers agents, and so forth to really understand the knowledge, right? Your association with debt, and also what's the next steps once you're paying that off, right? If we're talking about equity and you don't understand in the show, I think it's important to get a bit of research and understand, because that's how people, once their income gets bigger or go into a business, move forward by investing in further investments, isn't it? Right? Or zero money down, right? That's another kind of concept that's going around. Yeah. Sorry, I'm a bit excited when it comes to property home loans, as you can tell. Yeah. So we kind of like educate, but trying to break it down so it's easier for them to understand. Yeah.
And one thing you touched on as well is that a lot of customers are coming through like, can we borrow the whole amount? Can we borrow the whole purchase amount? And like you just said there, in regards to structuring, in most scenarios, yes, you'll be using equity out of your current property and you'll be purchasing at 80% or whatever it may be, which is the full amount as well. So that's something a lot of, not just the younger generation, just a lot of customers in general, they're like, oh, no way, we can use funds that we have currently now in our property to purchase. And we're like, yeah, you can. It just depends on the scenario, the servicing, of course. And that's, I think I'm glad you're on the show, man, because that's really opened up eyes. And I hope like the 2 or 3 listeners that we have can pass it on to their friends, etc. But that's actually like 100% you can borrow if you've got current property at the moment and you're looking to purchase the next property. You might be in a situation where you can actually borrow the whole 100%.
Yeah, and there's maybe questions like, hey, do I buy now? The question is, can you afford it? Can you service? If the answer is yes, it's about negotiation anyway, right? I mean, we can do the pre-approval as mortgage brokers, of course. But I think the key thing, it's good that you guys have this show, is this clients don't know what they don't know. What I mean by that, are they getting financial education from their mum and dad? Are they getting it from YouTube, TikTok? What sort of financial education are they getting from? And sometimes we all know it's not detailed enough, right? How can we explain what we just explained in a TikTok 10-second video? It's just impossible, right? Yeah, there could be snippets, and that's where, oh, I didn't know that. Oh, and then if they ask how, of course, do you have an hour that we can sit down? Then we'll explain and break it down. Okay, do you have a savings? Do you have family guarantors? We explore all these options. And then it may be sometimes no. And sometimes no is a good thing. It means you're not ready. You need to do some prep work before, as mortgage brokers, we can get you ready to go on a purchase. Or if it's an investment, you mentioned about no money down through the equity. But another way could be just refinancing, getting that OPM or the cash out, right? And then you got the deposit, the place to go for the next property. So we can there's so many ways, isn't it, where as mortgage brokers, but when we understand the client's situation, we can always provide, 1 or 2 or even 3 strategies, isn't it, right? Sorry, I'm just going back to mortgage brokers, but I think it's just so important to talk to an expert. That's what I'm trying to say, yeah?
Yeah.
Cool.
No, for sure. We agree, and that's why we're happy to have you on the show, and that's why we speak to industry experts every week to enlighten people, and especially people who are excited. So that's good. I had a maybe random left field question, but I kind of thought about it when Fadi was talking about, and yourself were talking about borrowing 100% of the funds, for example, or borrowing more than the standard 80%. And I was going to ask about lender's mortgage insurance, and because you also touched on when is the right time to buy, and essentially the answer was when you're ready, right? When your finances are ready. Not your advice, just your opinion. Your opinion regarding lender's mortgage insurance. I've got an opinion of if it means getting to the market earlier and the market's moving too quick, jump in, use it. If the market's that not moving and you can save up and avoid the LMI, why not? What's your kind of stance on lender's mortgage insurance?
Fadi, did you want to go first? Oh, yeah, I'm going first.
In regards to things, I'm with actually KM. If it gets you in the property, then I believe it's a price over 30 years to get you into the market. So if you believe that your next step is to purchase your first home, purchase an investment property, and I think again, like customers that we have in common with KM and Mark, where people are trying to get into the investment property, and people we've got a few lenders that are going up to 95% OVR for investment, where most of the big fours all of the big fours and most of the other lenders only go up to 90% LMI. I believe if you're ready and you're in a position where you can service that loan and you're paying a little bit of LMI, I believe it's worth it. If you're ready to get into that situation, then don't get me wrong. Sometimes when I see LMI above 40K, I freak out and I'm like, oh, can we put a little bit more money down to lower the LMI portion? Because as you know, Alan, anything under 90%, it's quite a massive difference in regards to the LMI. It can be a difference between 10 to 20K. Sometimes it just depends on the purchase price. So I believe in most scenarios, it is worth it to get into the market if you are ready. If you're in a position where you're financially ready, then I believe over 30 years, what's 20K over 30 years? That's like a personal loan, but it's over 30 years.
Plus, my take is more like understanding the repayment. I think during the pandemic, it was a period like where I feel the mortgage repayments with mortgage insurance is lower than what you're paying in rent, right? So I guess, if that's the case, why would you not get into the market and over long term experience some sort of uplift, right, in terms of your property value? The other thing also, I guess there's so many schemes now, and depends if you qualify, the FHLDS, which is the first home loan deposit scheme. I guess it's 95% with no mortgage insurance, but there's certain criteria that you need to fit in. There's also lenders that are coming on board that nowadays. You mentioned, there's 85% with $1 LMI or no LMI, like the mortgage insurance. So, we've been in the game long enough. We just want to explore and leave no stone unturned. That's probably our philosophy. But of course, if they needed to go to that 95%, just be mindful it's, most lenders is including the mortgage insurance on an owner-occupied property, whereas investment, it's only capped usually at that 90% mark, right? So I guess with leverage, it's double-edged sword, right? Of course, you're using less of a deposit, but it's really important to have kind of like a good budget, good savings, because if it doesn't go up in value, and it's not like we talked about refinance, but we really need that property value to go up. So your debt, your remaining balance to the new valuation is at that 80% or less, then we can refinance with no mortgage insurance. Now, we've seen a lot of scenarios which was very fruitful in the last 12 to 24 months with the pandemic. It was like, hey, let's refinance. Boom, the equity shot up 100, 200,000, right?
Yeah,
But
yeah.
I think with a downturn market, we just got to be a bit cautious, not to say no, but I think it's just explaining, if it goes up, what happens? If it's stable, what happens? If it goes down, what happens? It just means that if it goes down, you're not stuck, just with your lender for a little bit longer until you pay down the debt at a good level, then you can refinance and so forth. But I strongly recommend, if you can, right, get into the property market and it's lower like repayments than your rent, like why wouldn't you buy a property, right? It's just no brainer, I feel anyway.
And again, it's going back to that mortgage broker, seeing your mortgage broker, whether it's Alan, Mark, or myself. And there's also lenders for first-time buyers that are coming in that give you a reduced lender's mortgage insurance. There's more discounts on that as well, where customers are not aware of as well. So I think if a few lenders had, 20 or 30% off lender's mortgage insurance if you're a first-home buyer. So again, go back and see your mortgage broker, who will then in turn send you to his buyer's agent at First Brick. So
yes, I think getting the finance is forever more important, isn't it? Yeah.
I've got another kind of left field question. I know we didn't discuss this when we spoke before, but as you guys are speaking, things are popping in my head. So I hope you don't mind me asking. So February 2023, we're expected to see Dom Perion's new, I don't know what his last name is. I call him Dom Perion. The new scheme regarding stamp duty becoming a yearly property tax, they're calling it. This isn't a new conversation. This has been spoken about for many, many years, and I did a little video about it quite a while ago. But now they're looking to trial it with first home buyers from next February. We haven't spoken about it on the podcast yet. I just thought maybe I'd ask for your take. What's your opinion? What do you see? Do you see this? I can see potential issues with it. I can see the benefits with it as well, but I can see quite a few issues in terms of creating a two-tier market and whatnot. And just before I ask you, I guess I'll explain what it is, in case no one's heard about it. Essentially, the New South Wales government and some other governments are looking at removing stamp duty for first-home buyers purchasing a property under $1.5 million and replacing that with a 0.3%, I guess, land tax, which will be paid forever. With no end date. What's your take on this idea?
Fadi, you go first.
I'll make it quick because I can go into this for a while, but I think this has already been done as well in Western Australia from memory. And we've actually had customers from Western Australia that were looking to refinance. And I think it's more towards not just the property tax, but the actual scheme that he's looking to bring out under Labor as well, which I'm personally not really a fan of, because Mark, correct me if I'm wrong, or Alan, correct me if I'm wrong. the government pretty much owns 40% of your property, and you would only need 2% deposit to put down to purchase that property. So if you were looking to sell your house later on, please correct me if I'm wrong, the government owns 40% of that, don't they? Is that correct?
I think there's two schemes. One is that shared equity, that's what you're talking about.
Yeah.
But I think maybe Kyrilos is talking about the stamp duty going in, right? So there's two different.
And isn't that going to be in addition to that as well, which scheme you go through?
But I think the key thing is we're not sure because I did have some clients ask me too, and I'm like, with the government, they try to sell something first and then they think of the policy later.
Yeah.
So it hasn't been in concrete, like what the criteria is going to be, isn't it? Right. So.
And right now with land tax, look, I know from experience purchasing my house, I think I paid very minimal land tax, and it was a one-off payment. Even though I paid a very minimal land tax, it was a new home, wherever it may be. I just don't see myself wanting to pay land tax every year. Like, I don't see anyone wanting to pay that portion every single year, property tax, not land tax, property on the portion. So for me personally, I'm not too much of a big fan of it. And I can definitely see many problems arising from this as well. Maybe not so much in the short term, because short term, for example, with COVID, we saw a short term of people able to service a loan, able to buy a house now where prior they weren't able to. And with all the schemes that are coming through, or the rebates, it was really good for the short term. But in the long term, that we're going to see a few problems arising. I think it was the same thing with this one as well.
Yeah, I agree with you. Like, I feel like if you were paying stamp duty right now, obviously you don't have to pay any land tax forever, right? It's exempt, right, up to a certain threshold, of course. But if it's forever, right, and you're very young age, right, the more younger that you buy, you're probably more disadvantaged because it's you have to pay that ongoing, right? So, and the point something percent depends on the land value, and like land value is just on your council rate, and they just whack a number on there, right? So you can't justify whether, oh my God, it's $1 million, 0.3. That's, I think, like, what 0.3 is, $3,000, isn't it, right? A year on top of your council rate and water rate. So I think, like, if they remove that, it's easy to get in, right? A lower deposit, of course, because you don't need to factor in stamp duty, but it may be a bit more cost in the long run, and something to be aware in your budget to make sure you account for. Yeah. But the share equity scheme, I guess, yes, you're right, Fadi. They do have it in WA. I've done, one share equity scheme myself, but it's just that make sure the clients really know what they're getting into, right? When they sell, they feel like, oh, I keep all the profit, but hang on a sec, the government's, chipping in 40% to help you out. No, they get 40% of the profit, right? So I think those schemes need to be documented, right? A website like the OSR that we go in, it's black and white. That's when I really believe it. Hey,
I told the missus that if that land tax was to come through, if we ever were to purchase an investment property, it's going to be a caravan park, or sorry, not a caravan, a caravan car where there's no land. We're just going to purchase it and rent it out on the weekends for holidays. I don't see myself paying that tax, man. I don't want to be paying a yearly tax. Like, we're already paying bills. We're paying, like Alan was saying, we've got council rates, water rates, electricity. I mean, if you're living in an apartment, is there for apartments as well, they've got strata. So that's on top of the strata where no one really wants to pay strata either. So, and I think over a long term, even if you are going to be staying in that property for the rest of your life, I don't know, man. It frustrates me, to be honest. That can be another conversation that we can really get into it. But yeah, I'm not a fan.
I think it's a trade-off at the end of the day. Like Alan was saying, like if you're playing the research, it's not going to be that hard to calculate. But if you're sitting in the property and you're going to be living there for the long term, obviously stamp duty would have been better off for you to do. But if you're only going to live in the property 5 years, maybe 7 years, whatever it is, land tax at the end of the day will be cheaper. I think the people that would find this most beneficial is the first home buyers that we see that come to us. They might be having that 5% deposit and they can go through to the FHLDS scheme. But the issue is if they're purchasing over 650 and now there's stamp duty, especially if it's like over 800 or whatever it is, and the stamp duty is going to be like 30 grand. Maybe they don't have that 30 grand. And for them to save that while they're renting is an impossible task. It's going to take them too long. So I think for people like that, it definitely will be beneficial. Absolutely. But I think people that can afford the stamp duty and will be living in the property more than 10, 12, 15 years, obviously stamp duty will be the cheaper option. But yeah, I think you pick your poison at the end of the day. So,
But they'll be always in that position where even if they were to purchase again, they're going to be paying that land tax. So it's like no escaping it, unless they'll be renting again, or they go back to renting. Well, I guess that's where rent vesting really comes into play. Where you know what, there's another thing too, KM. If that's going to be the case moving forward, then get me out of my current home, rent it out, and I'm going to start rent vesting. Then we'll start that portfolio. But
Well, they're going to look into the numbers. I think that's the bottom line. And I think with these schemes and, you know, you and I or everyone here, like first home buyer, the home builder scheme, like just as long as it's in writing in the website, like, I mean, it's still a bit of information to navigate, right? But I think until it's in black and white, that's when, you know, we can really decipher what's better, isn't it? Right? So watch this space, isn't it? Mm.
Yeah. Yeah, for sure. Sorry for the left field question. I was just curious. I do have another question, and I know you said you didn't have a crystal ball, but I'm going to ask you to pull out one anyway. And I think we all know where we're going with interest rates. But like you rightfully mentioned at the start, I mean, we are still so low. Like the interest rate is relatively nothing compared to what it was prior to COVID and where it was in our, you know, back in the day, in our parents' days and whatnot. Where do you see the interest rates going, or do you see a slowdown eventually? You know, maybe at the start of next year they'll stop increasing rates or whatnot, or perhaps, and if they continue to increase rates, how do you, or have you already seen people? I guess, and that's why they come to you, but people panicking, people stressing about it, and not wanting to interact with the market.
Well, I'll start off. Yeah. In terms of interest rate, I guess, you know, I used to work in private bank, like when I was back in NAB. I mean, the RBA always talks about the bond rates. So it's a really good idea to check out what the, you know, long-term bond rates, or in fact, lenders 5-year fixed rate, if not longer, right? I mean, obviously the banks always shift their fixed rates in terms of up and down, right? Gives us an indication. I mean, obviously the last 2 months, the fixed rates 5 years, like let's say CBAs, it's like boom, 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 right? And we know that, you know, some rate rises are coming, right? You just kind of can feel it, given 2% and it's 5% or so in terms of fixed rates, just had to happen. So I'm not saying it's advice, it's something to check, like in terms of the trend. That's number one in terms of rates. In terms of clients, there's always clients going to be ringing, oh, like I just saw on the news. In fact, our industry, every month you should be getting phone calls because RBA is either stabilizing, increasing, decreasing. There's always that noise, right? But I think it's assuring at that particular time with the client that we found the best rate at that time. And also if their fixed rate's going to expire, do they have enough, you know, of a budget to repay? I think that's the key conversation. There is that emotion, you know, it's higher. No one wants to pay high rates, but my question is, can you control that? If it's something that you can't control, why you stress over it, right? Even if it's like someone that's locked in at a, like Fadi mentioned, one of a client's friends saying they got low rates, but after that fixed rate, everyone's going to be on a higher variable rate anyway, right? So sooner or later it'll hit you. I know like the media talks about it as a cliff and so forth, but that's why I say when we approve the loan, they factor in 2.5% buffer on top anyway. So I think it's just educating. Unfortunately, we can't control it. We've got to pay it, but we can review at that time what are the better, you know, lowest rate options at that time. Hopefully I explained. Fadi or Mark, over to you guys.
Mark can have again. Go ahead.
Yeah, I was just having a conversation with a client today about what we're talking about now, and essentially what I told her was, over your 30-year loan, you can't really expect, it's not realistic for you to think that you're going to be on a good rate the whole time. Obviously, the cash rate is going to go up and down over 30 years. No one really knows where it's going to be in 6 months from now, let alone 25 and 30 years from now. So although you can't choose to bring the interest rates to what they were 6 months ago, you can choose to buy in an environment where the buyers aren't as many as before. There's not as demand as there was 6 months ago in a year. You can choose to negotiate and purchase the price for whatever you wanted it to be in a market where it's a bit softer than before. But when the rates go up, you don't really have that choice. Oh, I want to get the rates from last year in November. No lender's going to do that. So you don't control the rates, but you do control what you purchase the property for. So buy when the property is soft and there's less demand, and you have more leverage when you're negotiating. And yeah, you see what the rate is on the day.
and it's forever changing. The another thing I just want to add, like, I had clients like, again, I'm just using that, my mom and dad kind of like, oh, I'm stuck with that bank. Not stuck, I'm with that bank for a long time. I'm like, man, you're paying probably a loyalty tax, right? When's the last time that you rang them and negotiate your rates, right? Do things that you can control, right? That's what I'm talking about, seeing an expert, negotiate with your existing lender, right? Just like ask. I think that's what we need to control, isn't it? Yeah.
I'll finish off with and I think Alan was saying this before, and Mark was saying it's over 30 years. Over 30 years, you're going to see a number of different interest rates, and you're going to be making a number of different sort of repayments as well. So in regards to the 30-year loan term, that rate doesn't really, I'm not going to say matter, but it's always going to be going up and down, up and down. So yeah, I think we're pretty much on the same page in regards to that.
So yeah, I think it's just very important to set a strategy for where you want to get to and how you're going to get there, because like all three of you guys have mentioned, the rates are going to fluctuate. And something that we've said on the podcast before is, the last 6 months of news or the last 30 days of news is not going to hugely impact the next 25 years of results, right? It's going to go up and down. So you shouldn't be making decisions and when you're buying real estate, it's a 20, 25, 30 year plus decision. And what's happened in the last month or 2 months or 6 months even shouldn't really be impacting, or shouldn't be a deciding factor in your long-term strategy. So if you have a strategy, usually this stuff doesn't matter too much. I had a phone call the other day from a customer and just freaking out, saying, I don't think this is the right time to buy. I want to pull out. I don't want to buy anymore. I'll speak to you later. My conversation with him was, mate, we've got a strategy in place. You can wait 6 months and it might go up, it might go down. We don't know. We can wait 2 years, same thing. We don't know. But what we know is our strategy is it doesn't really matter what's going to happen with the rate. So you set your strategy and, you hit your long-term goals and you'll be fine. But most important thing is constantly speaking to your brokers, I guess, to ensure that you do have the best available option at the time for your situation. So don't neglect it, but I guess you got to have a strategy. Otherwise, you're kind of just guessing.
Yeah, and I think Yeah, you go.
No, I was just saying, and you always think like we're always looking for the best mobile deal. We're always looking for the best Optus deal, the best Premier League deal. We're looking for the best mobile phone, the best price. But the one thing that most Australians do, and it was including myself up to when I got into this industry just about 10 years ago, like Alan, our biggest investment, we just let go. Yeah, the payments are coming out every month. Yeah, it's the same repayment. It's gone up by a little bit more, but we don't really do that check because we're scared of making that easy phone call.
Yeah. And also like investing, right? If you're like, even rates are 4-5%, but if your asset is returning 7%, all right, with what Kirilos is searching, I mean, it's just the answer, like people are scared because of rate, but what are they investing into, right? Or it's your long-term home that you're paying off over time. So I think they really don't see the big picture. And I think short-sighted, just focusing on the rate, which is important, but long-term view, right? Need to have that strategy to move forward. Yeah.
Alan, I was going to ask you right at the start, but Fadi was too excited, so he didn't let you speak. He started asking questions too quickly. I was just going to ask, do you want to just tell us a little bit about yourself and if anyone wants to reach out, where they can find you and how they can find you? And
yeah, sure. Yeah, definitely. So I guess a bit about myself. Like I said, I was 10 years in brokering, but before that in one of the big fours, been in private banking, different places. But the key thing is I started with my first home. I kind of like lost a lot of money leveraging my parents' home on some shares. And ever since then, I was too risky. I lost like up for 6 figures in one night playing options. But then at the same time, I realized that I needed to invest, right? So I started the investing journey. So obviously started investing in investment properties and started with one. And now me and my wife have 11 properties in different structures, commercial properties, residential across different states in different structures like your trust, SMSF, right? Commercial, residential. So therefore providing true passive income. And that's where we really understand the journey, like, or see a mortgage broker in terms of, are you a first-time buyer, which we can get you into what we call a level 1 investor, right? Getting your first step. Or you're level 2, which is a mum and dad, got a bit of equity, like, not sure what the next steps, how can we help you with the next one? All the way to level 3 and 4, a bit more sophisticated, like SMSF, unit trusts, joint ventures, right? We cater for the lot. But our philosophy is about we grow with you. So we understand where you are, so we can grow with you to take you to the next level. So that's what ZENRG is about.
Beautiful. And if anyone wants to reach out to have a chat with you, where could they find you?
Just www.zenergyfinance.com.au, based in Parramatta, but we service clients all over Australia. So simple as a Zoom, like kind of what we're doing in here, the online stuff, right? It's made it easier for people to connect, or even mortgage brokers, to be honest. But yeah, do reach out to a mortgage broker. That's all I have to say. Get quality advice.
Beautiful. We'll put your details in the show notes as well. So if anyone wants to reach out, you can. Fadi, Mark, any final questions to grill Alan with, or should we let him go home, go have dinner?
Go have dinner, and then we have to do this again. Definitely more of a catch up as well.
Yeah, definitely. Like, I love to see more mortgage brokers, and it's like, people that have a passion to help clients, right? Because I think when we're working in the banks, like, or usually the banker goes, right, or moves on, right? But mortgage brokers, they're their own business, right? They're around for a long time. They're probably good at what they do and really passionate about, because it's a business, right? But we want to help clients, and I think that's the message that we want to get across to clients.
Beautiful. Thank you so much, Alan. We really appreciate your time. I enjoyed it. I know we kind of veered off what we were supposed to talk about at the start, so apologies for that. But I think it was a good conversation. I think people will take a lot of benefit from that one. So thank you very much for your time. Send us a headshot or something, and so we can promote you all over social media. And
I'll use my LinkedIn photo. Yeah, I've got one of those, like, show me the money, show me OPMs, right? Yeah, which will help everyone. Yeah.
Send that.
And have OPM in the background, so
OPM coming along. That's the idea. Hey, look, really appreciate your time. You guys doing great work. Keep it up, because more clients going to benefit from your podcast. Okay, right? Okay.
Thank you, mate.
Right. See you guys. Okay, peace.
See you guys.
Bye.